The director's tax trap. Many directors pay thousands more in tax simply because no one ever taught them the rules of the game. Once you see the rules clearly, everything changes. I'm Stephen Pitcher, Senior Partner of St James's Place. And in this video, I'm going to walk you through the key tax allowances every UK company director should be using right now to keep more of the money your company earns, to reduce your tax legally, to strengthen your retirement planning and remove that quiet anxiety that you're just not doing enough for your future. This isn't bookkeeping, this is strategy. And strategy is what helps to transform long-term wealth. So let's go step by step. Now obviously the levels and bases of taxation and relief from taxation can change at any time. The value of any tax relief depends on individual circumstances. The salary dividend mix. Now your salary dividend structure is the foundation of everything. A well-balanced mix helps reduce income tax, dividend tax, employer's national insurance, employee national insurance. Picture it visually. Your income flows through two pipes. Salary is the narrow, high-pressure pipe, whereas dividends are the wider, smoother pipe. Balance them correctly, and the pressure drops instantly. But get it wrong, and money leaks out fast. Many directors use a standard mix chosen by their accountant, not a strategic one shaped around your retirement plans, your future allowances, and your long-term business strategy. When this is adjusted correctly, directors often say, "Why didn't someone show me this earlier?" Now we have the dividend allowance. Currently, every director receives a £500 dividend allowance. Yeah, it's small, but missing it is like leaving a window open in winter. Heat escapes gradually, but relentlessly. And if dividends slip into higher bands, you're currently paying 33.75% or even 39.35% in this tax year. Part of smart planning is keeping you out of those high friction bands whenever possible. Corporation tax and company pension contributions. This is where real transformation happens. Corporation tax is now 25% for higher profit companies. And directors feel that burden immediately. But here's the powerful part. A company pension contribution is fully deductible, and it moves money from a taxed environment into a tax-advantaged one. No employee national insurance. This is what used to happen with salary sacrifice. Up until now, if you use salary sacrifice to pay into your pension, you and your employer didn't pay any national insurance contributions on the amount that you sacrificed. There was no cap, whether you sacrificed £1,000 or £20,000. That whole amount was free of national insurance, on top of the usual income tax relief. What the last budget has just changed is that from April 2029, only the first £2,000 a year of pension contributions made via salary sacrifice will be exempt from national insurance. Anything above £2,000 a year sacrificed into your pension will attract both employer and employee national insurance at the normal rates. So the budget has effectively capped the NI saving on salary sacrifice pension contributions at £2,000 per employee per year. But income tax relief on pensions is unchanged. This is purely about national insurance. And going back, pension contributions pay no dividend tax, and they reduce your corporation tax. Imagine sweeping money off of HMRC's desk and placing it carefully into a sealed, secure vault, labelled Your Future. This is one of the most effective strategies for directors who value clarity, control, efficiency, and predictable progress. The £60,000 annual pension allowance, and this is probably the biggest allowance directors underuse. Up to £60,000 per year can be contributed into your pension. That's £5,000 a month. But company contributions mean you don't need to take this as personal income. And the result is immediate. Reduced corporation tax, zero national insurance, protecting long-term growth, stronger retirement planning. Directors often tell me, I wish somebody had explained this 10 years ago. Then we have carry forward of unused allowances. This is a hidden opportunity. If you haven't used previous pension allowances, you may be able to carry forward up to 3 years of unused allowances. This means you might be able to contribute £80,000, 100, 120,000 or more in a single tax year, depending on your situation. This is perfect if you've had a profitable year, you feel behind with your retirement, you want to reduce corporation tax at speed, and you want a structured extraction strategy. And most accountants never raise this because it isn't part of the year-end process, but it is one of the most powerful tools that directors have. The director's loan account. If you've loaned money to your company, you can take it back tax-free, as long as your account isn't overdrawn. But if it is, you risk additional Section 455 charges and avoidable stress at year end. Think of your director's loan account like a workshop. When it's tidy, everything flows. When it's messy, everything becomes harder. Then there's small allowances with a big impact. These are often ignored. Collectively, they matter. Mileage, travel, use of home as office, trivial benefits, staff events, company mobile phone, business expenses paid personally. Most directors dismiss these as too small to bother with. But over 5 years, these can mean thousands of pounds lost unnecessarily. These are like tightening bolts on a machine. Each one creates efficiency, stability, and speed. Now, the risk of a passive accountant. This is where many directors lose the most money. If your accountant only files your year-end accounts, never explains allowances, doesn't plan proactively, doesn't model future tax positions, doesn't discuss pensions, doesn't track national insurance years, and doesn't identify lost pensions, then you are missing opportunities. A bookkeeper records history, but a strategic advisor shapes your future. The difference between the two can be worth tens of thousands, sometimes hundreds of thousands of pounds over your career as a director. Then we have lost pensions and national insurance gaps. Almost every director has got old pensions from previous roles, forgotten workplace pension schemes, missed national insurance years, and outdated state pension forecasts. Finding these is often like discovering money you didn't know you had. Fixing national insurance gaps early protects your future state pension income. Many directors silently worry, I haven't done enough, I'm behind, I don't know where everything is. That anxiety disappears when the full picture becomes clear. If you're a company director and you want to keep more of your profits, reduce your tax legally, use every allowance available, strengthening your retirement plan and track down those old pensions to finally feel confident and in control of your financial future, then click the link in the description and book a no obligation retirement and tax efficiency discussion with me, Stephen Pitcher, Senior Partner at St James's Place. You've worked hard for your business. Now let's make sure your future benefits from everything that you've built.